Okay, I want to thank everybody for coming out today. Obviously, as you can see by the head slide here, we're going to talk about trading futures like you trade stocks. And if you don't understand what we're talking about, hopefully you will by the end of the class. The idea is people like the idea of trading stocks because they come with limited risk and the ability to earn dividend income, which cushions your downside risk. Futures contracts on the surface do not offer those advantages, but we can show you a couple ways to convert them into vehicles that act more like stocks than they do futures. Limited risk and income potential. Okay, so just in case you don't know who we are Carley Trading. We're located in Las Vegas, Nevada. We specialize in futures, options, and ideally integrity. That's our goal. It's a tough business, so but we like to bring our A game each and every day. It's tough to do, especially in markets like this. The volatility is massive. I know a lot of you are probably exhausted from the trading day, so we appreciate you coming out. My name is Carley Garner. If you have any questions or if there's anything we can do for you, you can visit us on our website, decarleytrading.com. You can give us a call at this phone number listed on the page here, or you can shoot me an email. I try to get back to emails very quickly, within the hour, sometimes much sooner. And if you're on social media, check us out on Twitter, Facebook. All right, so just a little bit of background information about me. I do write a monthly column for Stocks and Commodities magazine. I do contribute content to Jim Cramer's Mad Money roughly once a month, but sometimes it's more often, sometimes it's a little less. Just depends on what's going on in the markets. I also write a couple of newsletters that are exclusively for our brokerage clients, the DeCarley Perspective and the Financial Futures Report. You can sign up for a free trial of these on our website, decarleytrading.com. A new feature that we have available is we offer a mobile app. This is not a trading app. You can't enter orders into this app, but you'll find a ton of information, news feeds, video feeds, and most importantly, if we issue an official trade recommendation, you'll receive a pop-up notification on your phone letting you know what we think might be a good idea, why we think it might be a good idea, etc. So it's an informational app, not necessarily a trading app. I've written multiple books. The latest are Higher Probability Commodity Trading and A Trader's First Book on Commodities. You will notice a couple down below, Commodity Options and Currency Trading. Those two books, unfortunately, right now are out of print. We've switched publishers, and I will be writing Commodity Options again under the new publisher. The Currency Trading book, I probably will not be writing again. If you really want to know what's in it, we have a couple of webinars posted on our website that cover just about all of it. There is a substantial risk of loss in trading futures and options. Trading is not suitable for everybody. We want to make sure that everybody understands that. We're not necessarily investing, we're trading. It's speculative, there's plenty of risk. And what we hope to get across to you today is that the particular strategies that we're going to point out, they aren't risk-free, but they are less risky than just simply buying or selling futures contracts outright or many other types of speculation. So a lot of people ask me this question, is there an optimal place to be trading in commodities? Is it ETFs? Is it the futures markets? This is an opinion, maybe, more than a fact. But in our opinion, the futures markets are far more efficient and a much better place for people to be speculating in commodities. That said, it's not for everybody because leverage is involved. It can be a dangerous game if you don't truly understand the risks and what exactly you're doing and how to hedge those risks. So obviously, as human beings, we flock to what is familiar, what we know. And most people know stocks, and that therefore they know, or they think they know, commodity ETFs. They think that the best way to get involved in commodities is to trade with their stockbroker using commodity ETFs. In my opinion, this is completely false. Most ETFs are inefficient, and trading commodities with a stockbroker is a lot like going to a Chinese restaurant and ordering a cheeseburger. It's really just not what you're going to be looking for. Most stockbrokers that offer futures, they do it as a side product. They're doing it because they don't want you to take your business elsewhere to do that. They'd rather just keep it, obviously, with them, but they don't focus on it. They don't excel in it. They don't have a staff generally that's experienced in supporting that type of trading. So if you're going to trade commodities, I highly urge you to trade with a commodity trading brokerage firm. Hopefully us, but if not us, somebody that does specialize only in futures and options on futures like we do. So before we discuss some of the details of the strategy we're going to focus on today, I just want to make sure we're all on the same page and make sure everybody understands what a futures contract is. A futures contract is a legally binding, standardized agreement to buy or sell a commodity at a specific quantity and a specific quality at a set price on a future date. Standardization is key. Without this characteristic, it would be a forward contract. So as an example, if you're a corn farmer, let's say you have corn in the ground, you're going to sell it 6 months from now, what you could do is you could sell a futures contract that locks in the price. No matter what the price of corn does, goes up or down, you've already locked in your price. And the reason you're able to do that is because of standardized contracts. It allows people to buy or sell with a single mouse click extremely easily and very efficiently. If it wasn't for standardization of contracts, if it wasn't, if the futures contracts didn't represent a specific quantity at a specific time, at a specific quality, then it would be almost impossible to offset your price risk or even to speculate. Us as speculators, we wouldn't be able to go to the nearest co-op or talk to your neighbor who might have a cousin in Kansas that farms and try to work out a deal to buy or sell a commodity and speculate on the price. It just wouldn't work. But because contracts are standardized, we can easily open up a brokerage account and buy or sell in any order very quickly, almost 24 hours a day, not quite, but grains have kind of weird hours. They are closed for a handful of hours, but generally around the clock you can buy or sell corn, soybeans, wheat, anything you want to trade, and it's very liquid. The bid-ask spreads are generally a quarter of a tick. So for these reasons, around the clock market access, liquidity, and extremely efficient pricing, I believe that ETFs are inefficient and futures market trading is the place to be. So futures contracts are deliverable. A lot of people are scared to trade futures because of this very fact. They think that if they make a mistake, they're going to be forced to take on 5,000 bushels of corn or wheat or whatever it is. That's actually not true. It's very, very rare for anybody to take delivery of the commodity, especially if they don't want to. If they want to, it happens occasionally. Only about 3% of all futures contracts actually result in delivery of physical commodity. The other 97% are simply offset, and that means if you're long corn, you sell it to get out. If you're short corn, you buy it to get out. So all you have to do is offset your obligation with the exchange and you're off the hook for the delivery process. If you do make a mistake and you do happen to hold a position beyond first notice day, there is a chance that you receive a delivery notice. However, you have an opportunity to retender that notice with your broker. It's going to be costly. It'll cost you several $100s, but you will have an opportunity to offset that in a market outside of the exchange. So let's look at the primary differences between stocks and futures. The main difference between a stock and a future is the ownership quality, an asset versus a liability. When you purchase a stock, you're purchasing ownership of a corporation, and that's an asset. You're also purchasing any potential income streams, dividends, cash flow when you sell the stock, that sort of thing. When you're buying a futures contract, you are entering into a contract to take delivery of a specified commodity upon expiration. So this is not an asset, it's a liability. If you go long corn, you're not actually buying the underlying bushels of corn, you're going long a contract that represents buying that corn, but you're probably not going to ever take delivery. So that is a liability on your books. It's not an asset. Of course, if it goes up and you're able to sell it at a profit, the cash flow that you generate from that, that is an asset. I'm going to point out the advantages and disadvantages of trading futures as opposed to the alternative, which would be a commodity ETF or even some sort of commodity stock. such as gold miners or things like that. So the advantages of futures, you can buy or sell in any order. You don't have to worry about borrowing shares from your brokerage. You don't have to pay interest. It's easy. Anybody that opens an account in commodities it's done on leverage. So it's free leverage. You don't have to qualify for it. You don't have to have a $100,000 account. Most brokerages will open an account with a couple $1,000s. You're gonna enjoy expanded trading hours. I know the stock market does have expanded hours for certain participants. In commodities, everybody has expanded hours. You can trade around the clock in almost any commodity. If you're a crude oil trader, the market's open 23 hours a day. And that's true of the stock indices, the currencies, the metals. So you have access, point and click, immediate trade execution access, or almost around the clock. You can also, if you happen to be into option selling, which our brokerage caters to that sort of thing, we happen to specialize in that type of a client. If you're an option seller, it doesn't take, well, it depends on the broker, I should admit that. Depending on the brokerage that you choose, it's possible you could sell options in a relatively small account, $5,000 to $10,000. You could sell some commodity options. If you try to ask your stockbroker if you can sell options in an account with $5,000 to $10,000, he would probably laugh at you. So commodities opens the door and has basically lower account minimums and free access to leverage and trading strategies that you can't get in the stock market. Another benefit of trading commodities is you get automatic portfolio margin. Again, this is something that if you're trading stocks, whether you're trading stocks or stock options or a combination of both, to qualify for portfolio margining, you have to apply for it, and you probably have to have a decent size account, probably 6 figures or bigger. In commodities, everybody gets portfolio margining. Even if you have a $2,000 account, you automatically get it. And also, commodities are better when it comes to taxes. Not only are they taxed at a slightly lower rate because it's a blend between long-term and short-term capital gains, you actually don't have to report each individual trade to the IRS. You report one individual figure at the end of the year. Your brokerage firm will give you a 1099 and it'll tell you how much you made or lost. You put that figure on your tax form and that's it. It's very simple. Obviously, I'm a commodity broker. I'm going to highlight all the advantages of futures and options on futures because that's how I make my living, but there's definitely some disadvantages, so I want to make sure that I'm giving you the entire picture. The biggest disadvantages of trading futures is there's no dividends to cushion risk. Now, albeit in stocks, if you're collecting a 1% to 2% dividend and your stock drops 20%, that cushion is relatively meaningless, but at least it's there. In commodities, if you're long corn, there is no such dividend to help you out. As soon as you're in, you're facing risk. There's no cushion. There's no buffer. It is what it is. A lot of people argue that the futures markets offer too much free leverage. Too much of a good thing can be a bad thing, and I agree with that 100%. The futures markets are highly, highly leveraged, and unfortunately, as humans, we tend to push the limits. If somebody gives us excess, by nature, we take it. And so that's unfortunately what market participants tend to do in the futures. The worst part about trading futures is the idea of there being theoretically unlimited risk. If you're trading stocks and you go short, you're facing the same theoretical unlimited risk, but in commodities, you have it on the downside also. I mean, I know some will argue that it's impossible to have unlimited risk on the downside because a commodity can only go to zero, and that's true. The zero mark on many commodities is a really big loss. So for example, if you're trading crude oil and crude's valued at $65 a barrel, if crude went to zero and you were long, you'd lose $65,000. So technically it's true. The risk is limited, but let's face it, $65,000 is a ton of money on a single contract. Another problem with futures is diversification can be difficult for smaller traders. To truly be diversified, you'd probably need to be trading anywhere from 4 or 5 markets to maybe even 10. And in a small account, that's nearly impossible. Even if you're trading the e-micros and the minis, which I love, they're products that I love for smaller traders, you're still going to have a really hard time fitting more than 1 or 2 trades in a small account until now, and I'm going to show you a way to get around that. The other disadvantage of trading futures is the limited time horizon. And a lot of people find it to be a little inconvenient because if you really want to trade commodities the right way, you need to have a separate account. If you're mingling your stock trading with your commodity trading, you're not doing it the right way. You're not giving your commodity trading a fair chance to be profitable. Okay, so let's look at a strategy that will actually take futures contracts and make them feel a little more like trading stocks. So stock traders are spoiled. They enjoy several ETFs that are created to provide market exposure to particular sectors, including commodities. And it makes it really, really convenient, but it's also highly inefficient. Even commodity-specific ETFs fail to follow the underlying commodity. If you've ever traded USO or UNG on the stock side, you know just because crude oil or natural gas futures move one way or even the cash market moves one way doesn't mean that your ETF is going to make an equal move. And that can be really frustrating. And the reason that they don't is there's administrative costs. Commodity ETFs tend to have excessive contango. They're always trading the back months. I don't know if you're familiar with contango, but contango is the idea that there's a cost to carry a commodity or to store it. So the futures price of a distant delivery month is generally going to be higher than a futures price in the current month, and that's because it's representing the cost to carry that commodity. Commodity ETFs often buy futures that are expiring several months to maybe even a couple of years in advance, and as a result, they have massive exposure to contango. So what this means in English is even if the commodity doesn't go down, if it just trades sideways, that ETF is going to slowly bleed cash. Fortunately, there's now a liquid and viable futures market alternative to diversifying commodity exposure. The Bloomberg Commodity Index, or the BCI, it includes 22 commodities with weighting that cannot exceed 15% or fall below 2%. So they are rebalancing it from time to time. It is leveraged, but it's a relatively low margin product, and it seems to be relatively manageable on a P&L basis, and meaning you're not going to make or lose a ton of money in most circumstances, and the margin is less than $300. It does fluctuate, but let's just call it less than $500. So you can see the margin is very, very low. Right now, the index is trading somewhere around 75, but assuming it was at 80, each point is worth $100, so 80 points is worth $8,000. You're basically buying $8,000 worth of a basket of commodities on a margin of less than 500 and a relatively tame profit and loss perspective. Even if all commodities in the basket went to zero, you're only going to lose 8,000, which I acknowledge is a decent amount of money, but the odds of that happening are very, very low. And if it did happen, then we may not even be here to talk about it, like it might be the end of the world or something. So this particular product, it allows you to diversify into several futures contracts. It mitigates the contango that you're going to suffer. I want to be clear though, you'll never eliminate all contango in the market. You're always going to have some exposure to that. But a futures contract like the BCI is going to have far less exposure than most commodity ETFs do. You might be wondering if this particular product has enough volume to suffice, and the reality is it has enough. It's acceptable. It's not something you want to be day trading. It probably you're only going to see 3,000 to 5,000 contracts in an entire day. So it's something that you can buy and hold and be comfortable, but you really don't want to be overly active in this product because the liquidity is very poor. So this is going to give you a really good idea of where the BCI sits, and this is kind of a rude awakening when it comes to commodity prices, just how cheap we are. I know oil's doubled in value in the last couple of years, but aside from oil, almost everything else is just in the dumps. Gold and silver have recovered from their lows, but they're still really, really cheap. The grains are almost across the board, or basically at multi-year lows. So commodities in general are very, very cheap. The BCI is actually trading around 85, 83 right now, which is really roughly 10 points from the all-time low. But if you notice, the all-time high, which occurred in 2008, and that was when crude oil was $150 a barrel and everything was just flying high. But the high of that particular index was 240. So you can see we are way off the highs, but we're only marginally off the lows. So a lot of people might look at that and think, there's probably a lot more upside potential than there is downside risk. And at least that's how we're looking at it. So just to summarize, that is one way to get involved in the commodity futures markets in an efficient manner with a low amount of capital and a relatively low amount of risk. And it's the BCI, the Bloomberg Commodity Index. So there's another thing that we could do if we wanted to trade futures outright with a hedge. So for example, if we're not interested in trading a basket, we want to trade soybeans or corn or crude oil, we can use options around that particular speculation to produce income and to limit risk. So basically the idea is we're trying to modify a futures contract to behave like a stock. The best way that I've found to do this is to basically use a simple covered call strategy and then purchase catastrophic insurance. And so what I mean by that is go long a futures contract, sell a call option against it. That call option strike price is probably going to be near the money or at the money or maybe slightly out of the money, but the idea is you want to collect enough premium for that call to make it worth your while. If you're selling a deep out of the money call, you're not going to collect very much in premium, so your risk buffer on the downside is going to be minimal. And when you're talking about leveraged futures contracts, that's probably not going to cut it. So you want to sell calls that are relatively close to the money, or at least that's my approach to it. The premium that you do collect will provide a cushion to the downside risk. So if you're wrong and the price of corn goes down, the money that you collected for the short call option is buffering your risk on the downside. This is very similar to dividend cash flow in stocks. And the best part about it is it enables a trader to profit in a sideways market while waiting for the desired rally. Okay, so somebody's asking if you should sell the option at the same time or leg in. That's a personal choice. I personally do it at the same time, and the reason being my crystal ball is not clear enough to know where the market's going to be an hour from now or a day from now. So I've always had better luck just if I want to be long the market with a hedge, just put them both on rather than trying to outsmart the market, because I generally would lose at something like that. But it's a personal choice. We have clients that prefer to leg in, and that's fine. As if you think you have some sort of edge and ability to time the market properly, then it might work for you. But I would recommend going along the futures and selling the call simultaneously, and also purchasing a cheap put option also simultaneously to limit the risk. When I say buy a cheap put option, I'm not saying buy an option right underneath the futures price. So let's just hypothetically talk about an example here. If you're buying corn at 380 and you sell a 380 call and buy a 380 put, you might think you're a genius, because there's absolutely no way for you to lose money. But there's really no way for you to make money either. That's what you want to avoid. So you want to put on a position that's well hedged, but not so much that you can't make any money or lose any money. That's defeating the purpose. You're just paying your brokerage for the transaction costs, and that's it. So the idea is we buy a future, we sell an at the money call or a near the money call, and then we buy a cheap option underneath, a put option underneath. That put shouldn't be, you don't want to spend more than, I mean, each market's a little different, so I hesitate to put a dollar amount out there, but you don't want to spend more than $100 to $300 on that option. It's only there for catastrophic insurance. It's only there to protect you from tail risk. It's not going to protect you from normal ebb and flow. That's what the short call's for. And beyond that, I mean, let's face it, if we want to speculate in the markets and we want the ability to make money, we have to take some risk. So you're not trying to limit your risk to nothing. You're just trying to take some of the edge off. You don't want to be caught in the wrong place at the wrong time in a trade that ruins your whole trading account. So we'll talk about delta a little later, but ideally, like the put delta, you want it to be really, really cheap. And again, each market and each circumstance is a little different, so I hesitate to throw any rules out there. But you really, when you're buying your put, you want the delta to be very low. Again, it's just catastrophic insurance, just in case all heck breaks loose and you happen to be in the wrong market at the wrong time. So that was actually a very timely question. Let's talk about delta. The definition of delta is it's the rate of change of a particular position versus the rate of change in the underlying futures market. When I say position, a position could mean a spread, it could mean an outright futures, it could mean all kinds of things. So you have to just keep an open mind. But the idea of what we're trying to do is the delta on a futures contract is 1, because for every point the futures contract moves up or down, you're losing 1 point. You're making or losing 1 point. That's obvious. As you're selling options around that futures contract or you're buying options below, you're reducing your delta. You can adjust how aggressive you want to be by increasing or decreasing your delta. So for example, if your futures delta is 1, an at the money option delta is 0.5, meaning an at the money option is going to move about half as much as a futures contract. So if you go long a corn future and you sell an at-the-money call, you've reduced your delta to about 0.5. This is not an exact science. This is just to kind of illustrate how it would work. So you went from a delta of 1 to a delta of 0.5. So now you're only making or losing half of a point for every point the futures market's moving. So it slows everything down and it gives you more room for error. If you buy a put under the market, and let's say your put has a delta of 10, now you've reduced your delta from 0.5 to 0.4. So now your position is, it's like having, you can look at it this way. If your delta is 0.4, it's almost like having only a fourth of a futures contract. So instead of going long a full futures contract, you're only going long a fourth of a contract. The margin's going to be lower, the risk is going to be lower. Now keep in mind, delta is not static, it's dynamic. It changes drastically from day to day, and it can even change intraday. So just keep that in mind. A higher delta, just also keep in mind, a higher delta means more risk and a lower delta means less risk. And you as a trader, you pick how much delta you're willing to take on. If you're extremely risk averse, you might want a delta of 0.2 or 0.3. So along with creating a strategy that has limited risk and provides income, a great benefit of trading covered calls with the catastrophic insurance put is that it helps you manage your emotions. It's an effective way to mitigate the impact of emotional decision making. We've all been there. If you have a big position on, you're trading beyond your means, you feel every tick in the market. Every tick is stressful. Every tick that goes against you feels like more than a tick. It feels like 20, 30 ticks. Nobody wants to be in that state of mind. It's not only is it not fun, but it will almost always lead to dramatic losses because you're trading emotionally, not logically. You're probably breaking all your rules. So I've found, and I mean everybody has a different personality and a different risk tolerance and those sorts of things, but I've found that those traders that are well hedged, that have, you know, if they're long a future, they're short a call and long a put, they have their position on, it's directional, they know which way they want the market to go, but at the same time, they can benefit from time value erosion and they know that their risk is limited. Those two factors are a massive step towards mental stability, and that in itself puts you one step ahead most market participants. In addition to that, you don't have to worry about being stopped out prematurely. Anybody that trades futures outright knows that placing a stop loss order, it's the most popular, I'm not sure it's the best way, but it's the most popular way to manage risk on a futures contract. But stop orders, more often than not, I hesitate to say that because there's so many different scenarios, but a lot of the time, I will say, stop orders get hit at exactly the worst time or roughly the worst time. So if you're long the market and you place a sell stop, let's say you're willing to risk $500 in corn, so you go long at 380, you place your stop at 370, I can almost guarantee you that just normal ebb and flow, the sadistic nature of the market, that price is probably going to elect your stop at 370 and then it's going to rally up to 390. That's just unfortunately how it seems to work more than it doesn't. Can't explain it, it just is what it is. So if you're trading a strategy like this, you don't have to worry about placing stops because that catastrophic insurance that you purchased, that put, keeps your risk limited. But it also keeps you in the game. No matter what happens, if corn goes to zero and then comes back up, you're still in the trade. You didn't get stopped out, you didn't get knocked out, you were hedged, you were protected, you had a drawdown, but you were still in the game. This sounds overly simplistic, but it's so true. If you can never be stopped out, there's always a chance for recovery. Okay, so somebody is expressing some concern on the liquidity in commodity options, and that's a valid concern, but I would venture to say that as long as you're sticking to the major commodities, there's about 10, I would say there's probably only about 10 commodity markets that the average trader should be looking at. For example, corn, soybeans, wheat, crude oil, the euro, Treasuries, E-mini S&P, maybe natural gas. Probably try to stick to those. If you stick to those, you're not going to have any problems with liquidity. Even if you look at the open interest and you see that there's only a couple hundred contracts there, generally if you look at the bid-ask spread, you'll find it's really tight, and the market makers in the commodity markets are really, really good. It's pretty rare, I'm not going to say it never happens, but it's pretty rare that you look at an option chain and you don't see bids or asks or a fair market price. I mean, there are times like, for example, flash crash type of scenarios or just something really extraordinary happening where you do find that there's a lack of liquidity, and that happens in any market, even stocks. But for the most part, if you're sticking with the general major commodities, you're not going to have any problems getting in or out. And the best part about that is, this wasn't true a few years ago, but today those option markets are liquid around the clock. You can, even if you pull up crude oil options at 3 in the morning, you're generally going to find spreads that are 2 or 3 cents. During the day session, it might be 1 or 2 cents. The open interest and the volume may not be astronomical, but the liquidity is really good, and that's because of the market makers. Okay, so we've already talked about how a covered call with catastrophic insurance reduces the stress. It also gives you more room for error. It slows down the trade. You're making or losing less money per tick, but it also lowers the margin. And so this is a benefit in a couple of ways. If your margin's lower, you have the potential to have a higher return on investment if the trade works out. Now, I'm not a big fan of calculating return on investment based on your margin calculation or your margin requirement because, first of all, it generally will make your trading look better than what it is, because the reality is most commodity traders that have found a way to make money in commodities only use a small percentage of their account towards margin. So for example, if they have a $10,000 account, they're probably using 5,000 of the account towards margin. The other 5 is just sitting there just as a buffer in case something bad happens. In fact, a lot of traders might even use a lot less than that. They may even use 20, 30% of their account. So it's a little misleading to try to calculate your return on investment if when you're trying to brag to your friends. But it is something that people do talk about, so I threw it in here. But more importantly, you will have less chance of a margin call. And this is really, really big. When you're trading commodities, especially when the options are involved, there's a tendency occasionally for the volatility to explode, the options explode. And if you are trading a situation like just futures outright, for instance, that you don't have any risk buffer or margin buffer, you're at a much higher probability of getting a margin call and being forced to exit out of a trade or wire money. But either way, you're not going to be having fun. So if you're trading in a hedged manner, in a slower manner like we've discussed here, you're going to have a lot less stress. If disaster does strike, you're probably not going to get a margin call. Another great thing about this type of strategy and the fact that it comes with lower margins is that it enables smaller traders to get involved in the futures market with reasonable risks. So you can open an account with 2,000, 4,000 and do these types of trades, and honestly, probably, for example, we do some of these strategies in markets like soy meal and corn and wheat, and you can generally get something like this off with a margin requirement of 1,000 or less. So I wouldn't say you should do it in an account that has $1,000, but if you have 2,000 or 3,000 in your account, probably makes sense. There's probably not very many strategies out there that will make as much sense in that type of that size of an account. Somebody's asking if you could do this type of thing with treasuries or bonds. The reality is you could do this strategy with just about any market. It does depend on the particular characteristics of the market at that time. So for example, if volatility is really low, you might find that you can't collect enough money on the call strike price to make it worth your while. I think this strategy is best used in markets that are at a deep discount. So for example, the grains right now, we just mentioned that all the grains are trading near multi-year lows. This is a type of strategy that you might want to look at in the grains. I have not found this to be a great strategy in crude oil because for whatever reason, the options in crude oil are not priced with enough risk in them to justify this strategy. So for example, you might only collect $2 or $3 in crude oil in a crude oil call, but your crude oil risk on the downside might be 10 to 15. So it just doesn't make sense in crude oil. Almost all markets it does. We do it in the 10-year note quite often. It's not something you're ever going to get rich on because the 10-year note options are kind of on the cheap side, but we found that generally speaking, you can collect enough premium on the calls to buffer most of the downside risk in the 10-year note because it is a slower moving market and the margin is generally very, very low, 500 or less on something like that in the 10-year note. So just as a reminder, the purchase of a cheap put is really only for catastrophic insurance. It's not necessary, but it's a good idea. Anyone that's been selling options or doing covered call trading or any type of premium collection strategy, they're probably going to tell you the same story. They're probably going to tell you they make money on most of their trades, but there's a small percentage of losing trades that sabotage months or maybe even years of successful trading. Unfortunately, that is not an uncommon story. So the idea of purchasing this cheap insurance 99% of the time it's probably going to expire worthless. Maybe not 99, that's probably an exaggeration. Probably at least 8 out of 10 times you're not going to need that insurance, and it's just going to be money that you wish you wouldn't have spent. But I can guarantee you, when you do need it, you're going to be so glad that you had it. Occasionally markets make dramatic moves that cannot be predicted, they can't be managed. So if you're in the wrong place at the wrong time and you don't have some sort of tail risk protection in place, the market will show you no mercy, and nobody wants to be in that situation. So let's look at an example. A trader that's bullish soybean meal, and I picked soybean meal because granted it is a little less liquid than some of the other markets we've mentioned today in this class, but the great thing about soybean meal is it's much tamer than soybeans themselves, and the margin's quite a bit lower. So we tend to like soybean meal, although I'm not saying it's not risky, because trust me, it can move, but it's a little less risky than trading soybeans outright, and we think for most smaller accounts, it's a little more manageable. So anyway, if somebody was bullish soybean meal, they'd have 3 options. There's actually more options, but we're just going to simplify it. They could purchase a call option, but if they did that, the timing and direction must be perfect. Anybody that's ever bought an option knows time value erosion is the enemy. It works against your profits, and the odds of making money on a long option are not great. I like to call option buying lottery ticket buying. The risk is limited, but it's probably likely. You're probably going to lose. That said, every once in a while the market will make a massive move, and if you happen to have a long call option out there, it could pay off big, but that's the exception, not the rule. So the alternative would be they could just simply go long a futures contract, but when you go long a futures contract, you have to be extremely precise on the direction. You have to be really right. There's not a lot of room for error. The trade's immediately making or losing money. There's high amounts of leverage. It's stressful. You're probably biting your fingernails. You're probably not sleeping well at night. You can place a stop loss to limit the downside risk, but there's all kinds of complications with stop losses. For starters, there's a minimal chance, not a big chance, but it could possibly happen that maybe the market gaps below your stop. So let's say that something happens from Friday night to the Sunday night open. It's possible that your stop just gets skipped over. So there are things like that to worry about, although it's very rare that you'd see something like that. But the biggest thing that you should worry about if you're placing stops is premature stop outs. It's not guaranteed, but it's highly likely that if you place a stop, you're probably going to get hit. You're going to get knocked out of the trade with a loss, and then the market very well could go in the direction you wanted it to go. The other drawdown of trading futures outright is the margin is really high. So relative to an option spread like we talked about before, soybean meal futures margin is roughly $1,800. If you did a covered call with insurance, it'd probably be somewhere less than $1,000. In fact, actually I have it on the next section. If you did a covered call, went long a futures, sold a call, and bought a put, the margin would only be $950. And you're giving yourself more than one way to make money. The market doesn't necessarily have to go up for you to make money, although that would be easier. But if the market trades sideways, you still make money because the short call that you sell is losing in value and you're picking up time premium. When you're trading a covered call with insurance, the real risk comes in being super wrong. So you can be wrong and still not lose money. In fact, you can be wrong and still make money. But if you're really wrong, that's when it comes back to bite you. Okay, all right, so somebody's asking what happens to the short call as the long futures go up, and that's a good question. So keep in mind, there are 2 components to option premium. There's an intrinsic value and an extrinsic value. If an option is out of the money, all of the value is extrinsic, meaning that option, the futures price is not beyond the strike price of the option, so it's all extrinsic value. So if you go long a futures contract and the futures rallies above the strike price of your call, that call option is gaining intrinsic value, but it's probably still losing extrinsic value. So the time value premium is still eroding over time. And also your long futures contract is making tick for tick what your option is intrinsically losing tick for tick. So they just wash each other out. We'll hopefully answer your question with this example. Okay, so again, the idea is we want to turn a futures contract into something that is similar to a stock, has income properties and also limited risk. So if we went long a March soybean meal at 309 and then we sold a 320 call for 11 points or $1,100, that 11 points that we collect is cushioning our downside risk. Okay, so you'll notice the trade breaks even down here, and that's because from where we go long the futures down, the money we collected on our call option is buffering that. So we can be wrong and still make money at expiration. We just can't be too wrong. If we're too wrong, then we're starting to look at the market dipping down into this area. In this situation, we're buying a 270 put for 2 points or $200, so that does cut into our profit potential and our risk buffer. So instead of collecting $1,100, we actually are only collecting $900 on this trade. So that $900 buffers our risk down to 300, because remember we're going long at 309, so our risk is covered to 300. We can be wrong by 9 points and still make money. If we're not right or wrong and the market just stays right here at 309, we break even on the futures, we make 1100 here and we lose 200 there, so we make 900 bucks. All we had to do was not be wrong, and you make 900 bucks. So you might be wondering what happens if the market goes up, as somebody asked. If the market goes up above our strike price of 320, we're making money from the futures here. Okay, we're long from 309, we're making it up to 320. So that's 11 points or $1,100 that we would make. Above this point, you'll notice this diagram here, it just it levels off. We're not making any more above this. The most we can ever make is the 1100 on the futures plus the 900 net credit we collected. So roughly, we'll just call it $2,000 before considering commissions and fees and all that kind of stuff. So the most you can ever make is 2,000. That's the downside. If you're really right, you're only going to make 2,000. If the market gets all the way up here, everyone else is cheering about their riches, but you made some money and it was a good trade, but it's not that exciting. But the reality is a trade like this is going to make money far more often than swinging for the fence. So somebody that just went long of futures and swung for the fence, if the market gets up here, it's going to be great. They're going to make a ton of money. But in any other scenario, they're losing. So it's an opportunity cost. And again, everybody has a different personality. If your personality is the type that wants to swing for the fence and you don't care if you lose 9 out of 10 trades, you just want that one to pay off, then that's fine. That's kind of the concept that trend trading is built on, and apparently people make money doing that. But not everybody has the personality to withstand those kinds of drawdowns and that sort of thing. Somebody's asking if you could get in and out of a trade like this in a day. Sure, you could, because the market is liquid enough for you to get in and out as many times as you want. You could get in and out 10, 20 times a day, but you're probably not going to make money. On a trade like this, they're going to be slow movers unless you really timed it very, very well and you happen to catch a huge move. You're probably not going to see enough profit in a day to make it worth your while to get out. There have been times where we've been just kind of lucky and we hit it at the right time. Within a couple of days, we were able to pull out half of our profit potential, and anytime we could do something like that, we take the money and run. So it is possible for this to pay off in a couple of days. That's something that happens frequently. I wouldn't count on it. More often than not, you're probably looking at hanging on to a trade like this for several weeks, maybe even a couple of months. So it's definitely not a day trading type of strategy, but it could be if you happen to catch a big move. So this is basically just kind of reiterating what we had just gone over. I want to point out that the put we're buying way down here, the 270 put, again, we're not trying to protect ourselves if we're wrong, if we're slightly wrong. We're just trying to protect ourselves from the tail risk just in case something horrible goes wrong. In this particular case, soy meal has spent very little time under 270 over the last decade. We would feel relatively comfortable that it's probably not going to get anywhere near these levels, but it could, and if it does, we don't want to be there, so we want to limit our risk at 270. The max risk, though, would be substantial on this particular trade. It would be 3,000 if soy meal went all the way down here to 270, which it has not been for over a decade. It could happen, though, but It's not likely. If it did, we would be out 3,000, and that's assuming we didn't try to adjust the trade or make some other changes or that sort of thing. In the past, when we've had strategies like this going and the market's gone against us, we've tried to adjust. Like, for example, we might have an opportunity to take a profit on our long put and then maybe take a profit on our short call and then hold the futures hoping for a rebound to resell the call or things like that. So it's not like you're set in stone in these types of trades, but you want to be careful if you are peeling them off, because as you're peeling positions off, you're also taking your risk hedges off. So you want to be careful with that. But don't think that you have to put this trade on and hold it all the way to the end, because that's absolutely not true. You can get out at any time and you can adjust it at any time. I would say probably at least half of the time you're going to get some sort of opportunity to adjust your position. And sometimes it works out for you. Like I've seen, for example, a corn trade that we had that didn't go so well because of the tariff tantrum and all that kind of stuff a few months ago. We just kept adjusting. When the market sold off sharply, we'd take profits on our put, and then we'd buy another put that was cheaper, and then we would take profits on our calls and then hope that the futures rebounded. And so we did that a couple of times. We didn't make money on it, but we broke even, and we were dead wrong on the pricing. So just be on your toes and always look for an opportunity to catch the ebb and flow, and hopefully, you'll be on the right side. Everybody has a different idea of what they think is a good setup, what they think is an optimal situation. We tend to be counter trend traders. I think for whatever reason, it's just how I'm wired. If everybody's bullish, I tend to be bearish, and vice versa. So with this particular strategy, we tend to look for markets that are in the dumps, like we're looking at here, soy meal. $300 soy meal is really cheap. It can get cheaper. It's been a little cheaper, but only a few times ever. Well, I shouldn't say ever, in recent history. So we look for markets that we think are cheap and have little downside risk but big upside potential. And so that's how we use this strategy. But I've seen people do it as like a trend trading technique and that sort of thing. So to each their own. You just have to kind of play around with it, paper trade it with your particular setups and trend and strategies, and hopefully you can find a way to make it work. I know it's far more exciting to trade futures outright with no hedge. Forget about options. They complicate things. They slow things down. But trust me, it's no fun. Trading futures does not have to be the highly leveraged and stressful experience that it appears to be on the surface. I know it gets a bad rep. When I tell people I'm a futures broker, they don't want to talk to me anymore. It's hand to the face kind of stuff. And I get where they're coming from. I've heard horror stories of people losing their house and their car and all that sort of thing. But the reality is, it's not the markets that's doing that to people. It's people that are doing that to people. The trader himself chooses the amount of risk and leverage that he accepts. The difference is in futures, the leverage is free and the leverage is plentiful. And so futures traders or people that participate in the futures markets have to have a substantial amount of discipline to keep themselves out of trouble. In my opinion, the primary difference between making money and losing money in futures, and you can even apply this to stocks or Forex or anything else you might trade, is managing emotion and avoiding hysterical decision making. Emotions will get you every time, and if selling options and buying options against your futures contracts helps you to calm your emotions and make better decisions, then you are going to be light years ahead of most people. Okay, I'd like to thank everyone for coming out. Tracy's saying we have a couple of questions, so let me see if we can get those answered. Okay, so someone's basically asking if you could do this strategy in reverse. So instead of doing covered calls, do covered puts and then buy your catastrophic call insurance. And that the strategy absolutely is the same. It can be flipped the other way. I just chose to keep it with covered calls for simplicity. This isn't a really long class. I didn't want to confuse anyone unnecessarily, but you can absolutely do this in reverse by selling a futures, selling a put, and then buying a cheap call. Okay, so someone's, I believe, asking about commission, mentioning that they're paying 50 cents all in for options. I'm guessing, I could be wrong, but I am almost positive you're talking about stock options, not futures options. Okay, so futures commission's charged a lot different than stock commission. It's not on a ticket charge, and it tends to be higher because the risks are higher, the leverage is higher. Like as a brokerage firm, we actually are accepting a substantial amount of risk. So if our clients put on trades that are leveraged and they lose more than they have in their account, of course we contact the client to cover that and make their account whole. But ultimately, if the client's unable to pay, we pay as brokers. Unfortunately, I've had that experience more than I'd like to admit. For that reason, because brokers take on risk when allowing their clients to trade on leverage, it is necessary to charge a higher margin. Also, the fees and exchange fees and things like that tend to be higher on futures than they are stocks. But if you want to send me an email, I can give you an idea on commission. I mean, I would venture to say, like, our commission structure is a little higher than most, but we believe we're the best value. We give a ton of service, trading recommendations, ideas. We answer our phone. We help people around the clock. So it's just a much different service than your typical deep discount brokerage. Okay, so someone's asking what the margin might be on that the ZM position, similar to what we did in the example. So in that example, we sold an out of the money call, not an at the money call. But that particular example was running $950 to $1,000 when I ran the margin on it. We generally, like if we put out a recommendation on it with a strategy similar to that, we'd probably be selling an at the money call, so it'd be a little different. And I would say if you did an at the money call, it would probably only be about $600. Depending on which strike prices you choose, you could be anywhere from $500 to $1,000 on something like that, which isn't too bad. Your profit potential is anywhere from like $1,300 to $2,000, depending on how you structure it. The profit potential is pretty good relative to the margin, but again, like I mentioned before, that can be a little misleading, so you want to be careful before you brag about something like that. All right, so somebody's asking about data feeds and that sort of thing. We're what's called an independent IB, so we clear through multiple clearing firms. That said, most of our clients clear through one particular firm. The data feeds at that firm there's a proprietary feed and then also CQG, and actually the proprietary is actually a CQG product. So they're basically CQG feeds, but it gets a little more complicated. It depends on, because even with those two feeds, there are several platforms to choose from and that sort of thing. If you go to our website and go to platforms, there's a list of about 30 that you can choose from. Most of our clients use the first one on the list. It's a Zaner 360. It's free to use. It has option chains, option spreads. It's extremely efficient when it comes to order filling and data and that sort of thing. Okay, so and as far as cost goes, it depends on platform and that sort of thing. But to give you an idea, on our most popular free platform, which is the Zaner 360, you are responsible for the exchange's data fees, which are $3 a month, and that gives you all the CME exchanges, top tier data. So that would be metals, energies, currencies, grains, meats, stock indices, treasuries. The only thing it wouldn't get you for $3 a month is the ICE products, which is cocoa, sugar, coffee, orange juice. Those products trade on a different exchange, which charges an arm and a leg for data. We don't recommend subscribing to that particular exchange's data. You can still trade the products without subscribing. Thank you again for coming. If you have any questions, or actually, I almost forgot to mention, if you're interested in learning more about some of the things that we talked about today, we go into a little more detail in higher probability commodity trading. That might be of interest to you. It's available at any major book outlet, but naturally it's cheapest on Amazon. And if you have any questions or you think of something later, feel free to send me an email or give me a call. Here's my information, and I hope to hear from you soon.